last week's PCE numbers that came out. How did you interpret the numbers that came out?
Very bullishly, very bullishly. So let me pull up a chart for you, and we can do some screen sharing. Let's see here, screen share. Gosh, don't you love technology? So I think I pull it up for us right here. Yeah, so here's the PCE number. So PCE, personal consumption expenditures, tracks the price of a basket of goods the U.S. consumer pays for. La-di-da-la-di-do. It's what the Fed watches for inflation. It's basically the inflation rate of the United States. So as you can see, the inflation rate of the United States decreased right here in November 2020. We went from 1.17% year over year to 1.11% year over year from October to November. And that was the last time the inflation rate decreased in the United States on a year over year basis. Throughout the final month of 2020, every month of 2021, and the first few months of 2022, the inflation rate increased every single month. It was a record 16 straight months of accelerating inflation in the United States of America. That hurts. That adds up. That's why that's a big reason why stocks have been under pressure. Then you see right here, we topped. Boom. 6.61% in March, and then down to 6.27% in April. So we topped. For the first time in 16 months, the inflation rate in the United States dropped on a month-over-month basis.
Okay.
So that's big. Psychologically, it's huge. Yeah, it was a tiny little drop off, but psychologically, it's massive. We've gone from consistently accelerating inflation to a top to decelerating inflation. Based on the trends I'm seeing, I think that deceleration persists. We've hit peak inflation. Now we go down. And I think that's the consensus on Wall Street. A lot of people think that. But I believe the pace of the deceleration is going to shock a lot of people. It's going to shock a lot of people. So actually, I'm going to pull up one more chart for us that I think is very, very interesting and something that I believe is worth sharing. So let me pull this up. So can we see this chart here?
It is loading right now, but yep, we can see. Yep. All right.
Okay. Sorry, it's not. Let me see if I can open image, a new tab maybe, and that can be a bit bigger. Nope, thought that would be bigger. Oh well, that's fine. So this is a measure of the year over year growth in the M2 money supply in the United States. So M2 money supply, technical definition is M1, M2, M3, different levels of money supply. M2 is the one that is the most actionable money supply. So just view that as the amount of money circulating in the U.S. economy, actionable money circulating in the U.S. economy. As you can see, during the past 20 years, we've averaged anywhere between 5% to 10% year-over-year growth in the M2 money supply, right? We kind of bounce around. Sometimes we break below. Sometimes we kind of come up right to 10%. But that's where we've averaged for the past 10 years, right? They're 20 years, sorry. Now, in 2020, we spiked throughout all of 2020. We were above 20%. Because of all the money printing that went on, all that. And then throughout 2021, we were pretty much above 10%, right? We were in the 10% plus range. But now here in 2022, we've fallen. I believe the last reading was around 8%. We've fallen back into the historically normal range of 5 to 10%. So this is a sign that demand is moderating.
Okay.
That the amount of money in the economy, the growth of that money is slowing to historically normal ranges. So for me, that means falling demand.
Okay.
Then you have rising supply based on the supply chain issues we just talked about, them getting better, them resolving, supply chains getting back to normal. So you have a situation where I think the stage is set for massive supply growth, massive demand destruction. That leads to very rapidly decelerating inflation. I think we go from 6% to 2% in about 12 months. And I think by the middle of 2023, second quarter of 2023, we're back to 2% or lower inflation rates. That's important for stocks, obviously, because as we've gone from 2% to 6% inflation, stocks have gone boop, boop, boom, and they just crashed. As we go from 6% to 2% inflation, do the flip, stocks are going to do the flip. We're going to go, woo! We're going to soar. Stocks are going to soar. So I think that not only is the inflation, we've reached peak inflation, and that inflation is going to decelerate, but it's going to decelerate more rapidly than the consensus expectations have priced in, which is going to lead to upside price appreciation in stocks and all risk assets, really. So I'm really constructive in what I'm seeing on the inflation picture as well.
So essentially, investors have a lot to look forward to in the next 12 months.
In my opinion, yes. I think that the inflation situation is going to meaningfully improve. That has been the biggest bane of stocks over the past 12 months. As it becomes a tailwind, that's going to really help stocks move higher. So I do think the next 12 months could be pretty attractive. That's why I was researching throughout the long weekend to try and figure out, hey, the price action in the market is saying something, but is that something a head fake or is that something real? And I think it's something real. I'm pretty sure it's something real because not only do you have inflation decelerating for the first time since late 2020, but you also have the Fed is sounding a bit more dovish. They made a dovish pivot for the first time since 2020 as well, right? They've consistently sounded more hawkish essentially every meeting. And now the commentary shifted a little bit more dovish to a point where it's like, we're going to hike 50 in June, hike 50 in July, but then we're going to maybe wait and see how the economy reacts to those to decide what we're going to do in September. That is a dovish pivot. That is a dovish surprise. So I think the Fed is now shifting policy a bit. You're seeing valuations come down to levels that are much more reasonable and much more historically normal. So you're starting to see a lot of things kind of come into play here where I think that the stage is set again for stocks to perform significantly better over the next 12 months than they have over the past 12 months. And I think it's going to be a pretty big rally.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.